So let's start with talking about classes first. I've used classes in QuickBooks, and I generally treat them as probably a medieval person would treat the bubonic plague. And the reason for that is when you use classes, the presentation, the financial statements, and trying to do an actual versus budget simply becomes problematic because you have all of these columns, right? And you can do a summary view, but if you're trying to break out and say, okay, how's my sales department actual versus budget, or what's my, other departments, it becomes a lot more difficult for a human to kind of grasp that. So I go to what I call the row way of doing things. And here is a high level example. And I use this in the presentation. It's the exact same slide. And the reason I use this is it becomes very easy to do an actual versus budget right next to each other, department by department. And you can get it down into the detail by the account as well. And I'm going to go ahead and show that. But right here, from a presentation view, say to a board or to an investor, or somewhere along those lines, an executive, this is kind of a high level financial statement. And I always break out bookings income separately from the GAAP revenue adjustments. And the reason for that is a lot of companies nowadays, they want to know what's the volume of invoicing going through the company, because that turns into cash. But at the same time, they also want to see what the GAAP net income and the GAAP gross margins are. So the practice that I've come to is to, when your invoices are generated, instead of booking deferred revenue and debiting accounts receivable, you actually go ahead and book revenue directly and your accounts receivable. So whether it's recurring or non-recurring or services, break those out. So your recurring software, this is going to be obvious. Non-recurring software could be user fees if there's some kind of one-time user fee or something along those lines. And then services, obviously implementation or other delivery services that you charge for, because you're going to want to differentiate the gross margins at these levels and not treat them all the same. And then here I do the GAAP adjustment. And this is where SaaS Optics makes it super easy. All you have to do is run a contracts report. It's going to tell you what your deferred revenue, short-term, long-term, and unbilled AR balances should be. And then you just force your balance sheet to be correct, and everything else flows back to net income, goes into the GAAP. So it makes it, yeah, go ahead.
Clarification there though. So you've got a contract that's SaaS. Let's say it's 2-year contract. You're booking all of that to income.
So I'm showing the invoicing, and then on the back end at month end close, I run the report out of SaaS Optics that tells me how much of that needs to go into deferred, and then I book the adjustment here. So okay,
but in some cases that adjustment could be 90% of your booking income.
Could be. Yep, very much. But you also have to realize that's just for that month. You have all of the other recurring revenue that's also, piling forward that goes into that same adjustment. So by driving your net income in this way, you get the best of all worlds. You get to see what's my invoicing volume, and that's something that a lot of investors and boards, they kind of get that immediately. And then the CPA types and the other ones that want to see it on a GAAP basis, they get to see that as well. And so you just basically just create an additional line item here for that. And as I said, SaaS Optics makes that so easy because they have a report that you can run that will tell you for all of your open contracts what the deferred revenue balances should be. And so you just do an adjusting entry back to the to net income.
And theoretically there on that GAAP revenue adjustment, you could break it out in the corresponding line items of recurring, non-recurring, and services.
Yes.
For a little, yeah.
Exactly. And because when you set up SaaS Optics is set up at the line item level, and that's the beauty of the system. Each one of those line items is a product SKU, has its own revenue recognition rules. So if it's services, boom. Now, the other side of this is if you are going to be 606 compliant, truly 606 compliant, you're also going to be calculating deferred revenue on those services over the expected life of the customer. So that, there's that nuance that can also come into play. So it's not just the recurring revenue piece. That's easy. You're going to defer that based on the life of the contract or the term of the contract. But 606 also requires you to defer the revenue for any services that are associated with standing up that contract. And the amortization period is supposed to be the expected life of the customer, assuming that the gross margin is consistent throughout the period. So a couple of nuances there on 606.
Okay.
So then we come to the cost of sales portion, and I really like to break out my cost of sales into three buckets, because there are three different activities that are going on in cost of sales. Cost of production is exactly that. What does it take as far as hosting, any security applications, anything else that is directly related to delivering the software to the customer for them to use? So that's cost of production. Cost of delivery, kind of self-explanatory. This is your team or whoever it is in customer success that's specifically tasked with getting a customer up and running. And then the last one, I call it support and retention. These are the folks on, again, also on your customer success team, and they may be the same person, they may be different depending on how large your org is. These are the folks that are responsible for fielding bug reports, answering questions on the support desk, getting feedback from the customers and feeding it back into product or dev as far as feature requests. And then at the time of renewal, these are the folks that have the relationship with the customer. And so they should be the ones that are front and center saying, hey, it's time for renewal. You know, they should know if there are any expansion opportunities because they've been working with the customer. They should know what the renewal term should look like. And they either work independently or with sales to sign those contracts and get them going. I like to break it into those three buckets because those are three kind of distinct activities within the cost of sales, all of which I'd like to know what's my cost and what kind, what are we doing here? The other thing too is that if you break out delivery on its own, then your services and delivery, you can compute very easily a gross margin on your services portion in particular. Okay. So that makes that easy. So again, no need for using classes. This is all based on what I call the rows, roll-up accounts.
Right, but here's where I find that it becomes a challenge because, as you noted, some of the same people that are doing production and delivery or retention and then sales, which is down below. And so you've got some payroll coming in from whatever payroll system you're using. Mm-hmm. I mean, is it just a manual allocation that you're doing to push those numbers into the appropriate rows here?
If necessary, yes, that's exactly what it is. Now, most of your new payroll systems, HRIS, a lot of them you can either have an out of the box or a slightly customized export file created for you that makes it a lot easier for you to do the journal entries. So for example, Gusto directly integrates with QuickBooks, makes it easy by department. You can't do the allocations on the integration, but you can do it on the back end after it's landed. HRIS, Bamboo HR tracks payroll. They can set you up with a custom QuickBooks export file that does exactly that for you ahead of time with the allocations. So there are different ways to automate that as well. And most of those lean back on the payroll provider to, provide an export file, QuickBooks export file for you to import. But in some points, yeah, you might have to do a manual allocation. We just want to make that as simple as possible. Because I have those cases as well. And the one in particular in a current client where the delivery person, half of her time is spent on sales. And so we allocate half of her time.
Got it.
And I don't get too far, into that topic. I don't get too far into the weeds. I generally say, look, is it half? Is it a third? I'm not looking for time tickets. I'm not looking for them to track their time or do any specific audit. Probably because it's not really necessary at this point, as long as you're pretty close, unless you're being audited. If you're being audited, then you've got a different set of hoops to jump through to justify that allocation, especially if it's going to affect gross margin, which is something auditors really focus on, is the gross profit. So in those cases there, you may have to do an actual time analysis to find out, how much that time that person is spending. But as you're well aware, most of our clients are not in, the auditable financial statements stage of their company at this point.
Right.
Then I go further. So I've got the three main, and this cost structure, by the way, is following basically what KeyBank Capital Markets, formerly known as Pacific Crest, when they do their surveys and research on cost structure, what are CAC ratios, what is the average R&D spend, they are basing it on this particular form of income statement. We had a lot of work with them when we were at Duo Security back on, their surveys in terms of cost structures. So this cost structure here in particular is very easy to benchmark against the Pacific Crest Key Bank reports that come out every year that they do when they survey their several hundred, private SaaS companies that they're working with for these kinds of ratios. So that's why I in particular like to follow this particular approach. R&D, I like to break out product and research, excuse the, I just noticed the misspelling there, research versus development. And the reason for that in particular is development allows R&D tax credits, whereas pure product research doesn't. So I like to separate those out on the income statement. It makes it easier for our tax people to, pull out the development cost in particular. And then sales and marketing, they are two different things. It's not like country and Western music. They are very different. If you understand that Blues Brothers illusion there. So I like to see marketing separate from sales. And I really like that for a couple of reasons. One, marketing allows me to do what's called a return on marketing investment, a ROMI analysis, if we get down into it. So we can take a look at, on a lead gen basis that turns into, contracts, what is our marketing spend? How efficient is it? How effective is it? And then in G&A, I just like to break those out into their various buckets. Technology now, in particular, IT becomes, more and more important, especially if you have customers that are SOC 2 or they need to go to SOC 2, then you're going to want to see that spend. Finance and executive, is that top heavy? Do you need to trim that back? And then occupancy, which in the day and age of COVID seems to be becoming more and more rare, as I have, now 3 clients in a row who've all said they're not renewing their leases. They prefer the remote, model. So that's a cost savings to tech startups in particular, I'm finding is coming to the fore. So this is how I lay it out in roll-ups.